When I was getting into real estate investing, and I mean getting into it, I didn't even have a toe into real estate investing at this point. One of the things I was very quickly interested in, as most of us are, was creative financing. I had some money set aside, so I knew I was going to be able to do a little bit by myself, but I was going to need more fast because I was wanting to get in quick. I wanted to get lots of deals or big deals, or I didn't know, but I knew that I wasn't going to have the money to fund it all. I was at a conference and I met a guy who specialized in investment partner structuring. And I got to talking to him, and I think at the time I was actually looking into self storages, and he recommended the actual structure that he works with on commercial deals. And fast forward, when I ended up getting into residential, I tried to apply his partnership structure to the residential, but it didn't quite work because the commercial deals were so much bigger. You're making more money per month, the investment's bigger. It's kind of a different dynamic as far as the numbers go versus like single family houses, duplexes. The margins are a lot smaller, so the splits weren't quite working exactly right. So from that, I had his commercial structure, and then I had what I ended up coming with on as a related residential structure. So I thought I would share both of those with you in case either A, it gives you a structure that you can use either for your commercial investing or residential investing, or it at least gets your brain juices going about, okay, well, maybe this structure is not exactly right, but it does give me ideas on something I could do, because that's really kind of how it helped me. Is it gave me an idea and it allowed me to kind of work from there and figure something out. So I'm going to share my screen, and I don't know, I mean, I know this is super old school. Do you guys even remember PowerPoint and like slideshows? I'm not very good with technology, so it's the best you're going to get. So when I talked to him, the structure that he presented to me, and mind you, this was a professional, and it all made a heck of a lot of sense for me. So on the commercial deals, what he did for his personal deals was he would take 30% off the top, and that goes to the investor who is running the show. They're the ones managing it. They are not the silent partner. It's you. If you're wanting to do these deals, you are pitching this basically to a potential investor. So you say, hey, investor, I want your cash. We'll do this deal. 30% off the top, and this is of, let me clarify, this is of the net. So all the expenses get paid first. This is from just the profits, the net income from the property. So 30% right off the top goes to you, the active partner. That's basically your fee for me. You're the managing partner, really. And then what's left, you guys split 50-50. Pretty simple, right? So here I go trucking along, trying to get into residential deals. And I was like, okay, I'm going to do the same thing. Well, the minute I put the numbers in the spreadsheet, 30% off the top and then splitting 50-50 left like 17 cents for both of us after on the 50-50 split. Like there's just not enough margins on a small property to give 30% off the top. So what I ended up having to do was basically take that 30% off the top off and just split the net profit 50-50. Now here's how that balance worked. Let's see, you guys got all this? I'm gonna stop sharing my screen. So if you're writing this down, you can write it down or take a picture of it or a screenshot, and I'm gonna stop sharing it. Did you get your screenshot in? All right, back to me. So you have the structure. So then what I did on the residential property, because on the commercial deal, it made more sense because, me doing all the work and the managing of it or whatever, I get my 30% payout and then we would split 50-50. Well, in the residential, that's not working. So how does that split work? And what we ended up doing was me, who was the active partner, I was the one managing the project. I was the one who got the financing in my name because commercial financing, remember, is going to be in the company's name, not your personal name. So on the residential, I got the financing in my name, which essentially means I was taking on the risk and I was doing all the work. That constituted my 50%. His 50% was just the cash investment. So he put in the cash required for the down payment and the closing costs on the property, and I assumed all the risk because it's all in my name now, and I'm doing all the work. And we believed that that was now a 50-50 partnership. And so from then on, and we still have these properties today, from then on, all expenses, all income, and if we were to ever sell any of the properties, we split all of that down the middle regardless. Positive, negative, whatever it is, it's a 50-50 split, no ifs, ands, or buts about it. So, commercial deals, you may have the option to, for example, take 30% off the top. This is all of net income. Take 30% off the top and split the remainder 50-50. So that's what you would actually be pitching to an investor partner, saying, hey, for the work I'm doing, I'm going to take the 30%, but then we get 50-50, until you can also add in add-ons or addendums or whatever you want to say. Like, maybe I take 30% off the top until a certain point, or until, like, maybe that person put in X number of dollars and that structure stays the same until that person is paid back, and then it changes a little bit. So you have some options here to tweak that. And then for the residential side, forget the 30% off the top. It's not going to work. You have the option to potentially split, and this is the monthly cash flow we're talking about. This is not an appreciation play property. You can split the cash flow 50-50, and then therefore and that's based on one person taking the risk and doing all the work, and one person putting in the cash. And then all expenses of an income and a potential sale down the road is all split 50-50. Here's my one disclaimer about everything I just told you. I am not a tax professional. I am not a legal professional. I am not a professional in any of those. I'm a professional in other capacities, but none that help with this conversation. So absolutely don't go into any kind of partnership willy-nilly, and you need to make sure that you're protected. A lot of people assume that you should have an LLC for partnerships. Maybe it's not applicable. It depends, if it's commercial, for sure it's going to be an entity, but for residential, it may not be quite that. If you don't have a legal partnership, because on residential it can mess up your financing too. If you don't have the legal entity that can make you guys the legal partners, make sure you have a real estate attorney draft up a partnership agreement. So what happens if X? What happens if Y? Make sure everything is spelled out. I don't care if this is your family member or your best friend or a stranger, you need to be legally protected. So again, run the numbers for yourself, because I am not your accountant. Double check everything, potentially with an attorney, for sure the legal agreement, because you want to make sure this is all legal and on the up and up, but also just for the structuring in general, make sure that you are properly set up, because I'm also not a legal professional. What else can I tell you? I think that's it. It sounds basic, it sounds easy, but I know that I didn't know those options when I started, and had I known them sooner, I think I could have gotten a little more creative and really branched out from there and maybe done a little bit more with it. So hopefully those help you, and if you have any questions about them, shoot me a question in the comments.